Good afternoon and welcome to Tax Planning for Limited Companies, our latest tax planning webinar that we've been running throughout a number of sessions recently. Thank you for attending, we really appreciate that. We've got nearly 300 people registered to attend today, so it's going to be a really big session and we're excited to go through all the topics and answer any questions that you may have. So today's webinar, I'm joined by Andy Gibbs, who's a Chartered Tax Advisor who works for Tax Assist. I'm James Matton, the Group Business Development Director for the Tax Assist Group, and we're delighted to be able to help give you some tips and advice as best as possible for limited companies. Today we're going to be covering loss relief and COVID-19 planning, how that might have affected you all, efficient profit extraction, research and development tax credits, and then we're going to run through towards the end how Tax Assist Accountants is going to be able to help you with that. So just a quick run through. Who are Tax Assist Accountants? Well, we're a national network of accountants and tax experts. We have over 375 offices right around the UK, so we will have an advisor very close to you. We service over 77,000 businesses right across the UK and individual taxpayers as well. And so we're servicing businesses just like yours. Throughout this webinar, we'd love you to, if you have any questions, use the chat box. That should be quite readily available to you, and we've seen a couple of questions already come in. We are going to hold the answers to those questions until the end of the webinar, so we'll allow Andy to present to us, run through the session, and then we will address those questions absolutely where possible. We are going to be recording this webinar, so you will be able to watch this afterwards, and we'll send you a copy, and we'll be hosting it online across our websites, so you can visit www.taxassist.co.uk to visit those pages to watch any prior recordings. And we'd also recommend, we've done a number of webinars now, Andy and others in our team who presented on various different topics, a whole series of them so far, and we have a number also planned out coming forward. If you subscribe to our email newsletter, you'll be alerted to exactly when those are and exactly what time we're going to be holding those. We have two more tax webinars coming up next week for sole traders and partnerships and for individual taxpayers. So if any of that interests you, you could also register for those too. Without further ado, I'm going to hand over to Andy Gibbs, who's going to present the topics for you today.
Thanks very much, James. We're going to start off looking at loss relief and COVID-19 planning. It's we've done quite a lot of work educating and sending the message out about the COVID reliefs. We now think it's time to start looking at specific tax planning that can be done in respect of COVID-19. So we want to show how we can maximise tax planning for you and help your businesses in the current situation. Probably worthwhile just having a little recap of the situation, the unfortunate situation that we find ourselves in. Due to COVID, there has been a pretty significant contraction of the economy. So the Office for National Statistics has advised that the economy contracted by 20% in the month of April. And although there has now been a bit of a turnaround and businesses are beginning to pull through this, and a good performance was made in recent months, the fact of the matter is still the economy is smaller by about 17% compared to where it was in February. So obviously this is going to have an impact on us, all of us, and it's going to have a big impact on you and your company. And most companies will have experienced a downturn since lockdown, and they will have experienced drops in profitability, unfortunately. The one piece of good news from that is that obviously as profit does reduce, future tax liabilities will equally come down as well. So what we want to do is help you maximise that opportunity and maximise the cash flow advantage you can get from that change. So we really need to just have a very quick, brief look at how a company is charged to corporation tax. And effectively, a company is charged to corporation tax based on profits which arose during its accounts year end. And that tax is then due 9 months and 1 day after the end of that accounting period. So In the majority of cases, the year end is going to have a big impact on the amount of tax the company is going to pay. So if we take a popular year end, a lot of companies will draw their year end up to the 31st of March. So if a company was drawing up its year end to 31st of March, there probably wouldn't be in that set of accounts any kind of marked deterioration arising from COVID, because lockdown only occurred a few days earlier. So we wouldn't expect to see much of an impact on profits. But nevertheless, the profits which arose is how that company will be charged a corporation tax, and those profits will be due by the 1st of January 2021, 9 months and 1 day after the end of that accounting period. So that's going to come on the heel of a difficult 9 months of trading conditions and cash flow challenges, as we're all experiencing. In the next accounting period, of course, things are going to be very different, because to the 31st of March 2021, the company may in fact be in a loss situation, or at the very least, it's going to have much reduced profits. If it was in a loss situation, what the rules allow us to do is they allow us to carry back that loss to the prior accounting period. So when you've done your account to the 31st of March 2021, we can carry back that loss for you to the 31st of March 2020, and we'll reclaim tax, the corporation tax, because we'll set the loss against the previous year's profits. The one drawback with us doing it that way is you're going to have to wait for the cash. So we could look at altering some year ends. We'll come back to it later. We can shorten and lengthen accounts year ends, but in this example, we'll look at a situation where we extend the year end. So we were going to draw our accounts to the 31st of March 20, where we wouldn't have much of the COVID impact and disruption in there, and instead we'll draw our accounts to an 18-month period, and we'll close our accounts to the 30th of September 2020. By doing that, we're probably going to capture the negative impacts of COVID, most of those negative impacts. The losses that arose from the 1st of April to 30th of September are now fully captured in that set of accounts, and the corporation tax bill due on 1st of January 2021 will now be lower, and we haven't had to wait to get our refund. So this is something that may be useful to consider. If you want to discuss this, please do speak to your tax assistant accountant, who will be more than happy to explain how this could benefit you. As we said though, it won't always make sense to extend accounts year end, and sometimes we'd look to shorten it, but we will help to advise you the right accounts year end for your particular circumstances. In this presentation, we want to really draw on what companies are reporting to us now, and how COVID has impacted them, and current ways to maximise their tax position. So as well as looking at the accounts year end, we would always advise any company owner to look at how they extract their profit. The starting point for us is to look at how you take the money out of your limited company. And there's two main ways that directors can choose to take money out of a limited company. They'll take a salary out, which will reflect the work that they've done for the company, and they can also take from their profits, they can take dividends. We would recommend that you look at that extraction mix in a way to maximise your tax efficiency and reduce your tax bill as far as possible. So what we would generally advise to do is take a small salary from your limited company. This will allow you to gain the maximum efficiency by putting that salary through the company account, because it will be allowable, and reduce your corporation tax. Equally, if we get it at the right level and get the right mix, we can also ensure that you qualify for a year of state pension and qualify for other state pension benefits. There's a kind of double advantage in taking that low salary. If you continue to take salary, unfortunately, you'll hit into some nasty tax charges. There'll be national insurance charges, and there'll also be income tax. And income tax on salary is charged at higher rates to what it's charged on dividends. So what we would then recommend you do is you take out after you've taken out your more minimal salary, you would then take out dividends take them out to the basic rate band, because the tax rates on dividends within that basic rate band are only 7.5%. There's some other dividend allowances which we can explain to you how they work as well, to exempt dividends as well. So getting the salary and dividends mix right is really key to making sure that you extract money from your limited company in the best way for you. We've got years of experience of advising clients in this area, and we can help you with a generic best practice way of taking that mix out of your company. And we can also help tailor that for you if you have particular needs, or you want to have things like cars and you want to take a little bit more out. We can help you with that. Another key way to extract money from your companies could be for you to take a pension contribution. Entrepreneurs are always looking to plan for their future. And if you make a pension contribution from your trading company, you can actually get a corporation tax deduction for that. So, you know, the corporation tax deduction at 19% effectively means that to put £81 into your pension, or £100 into your pension, it's only going to cost you £81. So pension contributions are another good thing to talk to us about, because we can help explain how you could set up a company pension scheme to benefit yourself. On the subject of pensions, of course, most companies will have some members of staff, not all, but some. And if you do have staff members, you'll have some obligations to make pension contributions on their behalf as well. That can get quite tricky, making sure that you've set that up right, making sure that you've written all the letters, kept up with all the legal obligations. And we would be happy to help take that burden off your shoulders and deal with your company pension scheme as well. A few other benefit in kind topical areas that we're seeing now our clients asking us about to make some small tax savings, and also to avoid some potential tax traps which can come from getting things a bit wrong. COVID has affected many workplaces, and commercially not everybody is going to be working in their normal circumstances. We've gone at great length to try and make sure that we've pumped out as much information on all the government support that there is available to you, but there are a few missed ones and a few things just to be made aware of if you are employing staff, or if you wish to remunerate yourself as a director of a limited company. One tax advantage is to issue a mobile phone. The tax rules are really generous here. If you, as a limited company owner, issue your employees with a mobile phone, then even if they are making private calls from that mobile phone, as long as the phone is in the company name and the company pays the bill, there's no benefit to your employees, and that will include you as a director. So that's a really worthwhile benefit to make sure that you're not missing out on. Equally, on the bad side of it is that if you try and reimburse employees' telephone costs, you can run into a bit of trouble in terms of reporting and the tax charges that can arise from that. So it really is best to put the mobile phone in the company's name in the majority of cases. If you wish to discuss that or get any advice, then again, please do contact us. Another valuable benefit, which is very topical at the moment, is the ability to pay staff, including a director, £6 a week when they're working from home. This will cover the incidental costs of working from home. It is possible to claim additional expenses, but receipts need to be kept in those instances. But if you are now struggling working from home, or your staff are, it's important to remember the mobile phone trick and potential trap, and also the ability to reimburse staff if that's something that you wish to do. We also sometimes get asked what expenses for the use of home can a director claim, and there's a few. If a director wanted to, they could actually set up a rental agreement between themselves and their limited company. And this has the advantage that the rent paid from their limited company will be an allowable deduction. The only snag is they will then have rental income in their own personal name. So it won't work for everybody that, but we can help explain how that works. If you did set up that rent agreement, you would have, as we said, some rental income in your own personal name, which you would need to declare and deal with. And that kind of works when you've got a load of expenses that you can expense against that, mortgage and rent payments in particular. We can help advise if that is the right mix for you to choose. There's also a special £1,000 property allowance, which some people think is available for directors, but again, that's a bit of a tax trap warning. That won't apply if you are receiving that rent from what they call a connected company, which is your own trading company. So we'd probably say that in the majority of cases, reimbursement for the director for £6 is probably the way to go. So if your accountant hasn't raised that, then that's something to look at if you're now working from home, if you haven't discussed that. And again, we would be pleased to help advise you in that area. We also have to look at ways we can extract efficiently by perhaps involving some family members. There's again some pitfalls here, but it's a good planning opportunity. So in some instances, it's perfectly possible to pay a spouse some wages. Again, that will have an advantage. So if you are in that situation where that's possible, then do discuss it. Obviously, it's going to work best where that spouse doesn't have any income, so that you can use up all their personal allowances without incurring any tax charge on them. You said there's a few rules to just observe. The salary has to actually be paid, it can't just be a book entry. The spouse has to play a part in that business, and the wages can't be excessive in relation to the work undertaken. So a few things to watch for, but again, we'd be happy to advise if it's appropriate to put through a spouse wage in the future to save some tax. Additionally, it may also be possible to gift shares to spouses, which can also result in a tax efficient outcome. So put very simply, if you're making profit in your limited company of £50,000 and you extract it all as a dividend, it will be taxable as a dividend on yourself. But there may be instances where you could pass some of those shares, say 50% to your spouse, and then those dividends will be taxed 50-50. That works very well for spouses and civil partners. It can be more tricky in other situations, but there may be instances where we can help with that planning as well. So if you are interested in looking at giving shares to adult children, if you are interested in involving the family in the company and looking for tax planning opportunities, then please do talk to us. There's a few, again, caveats just to make sure that you do all of that right, to make sure that the shares have been issued in the right way, that they are a gift. So there's a few tax traps to watch there, but again, we'd be happy to help make sure that you've dotted all the I's and crossed the T's and put the planning in place correctly. There's a few other instances where you may need help. You may need help because your company is looking to bring in new investors. There are some specialised tax schemes that can help there. And again, we'd be happy to advise in respect of enterprise investment schemes, which will allow tax efficient investments into your company. We're also happy to help if you're looking to incentivise staff members, if you're looking at ways to make your staff loyal and to bring them into the business to help you make more profit. There'll also be instances where you will be looking potentially to exit your business, and we can help advise the most tax efficient way to do that. So in any of those additional service areas, please do talk with us, we'll be happy to help. Just come on briefly now to our last area, which is the research and development tax credit area. This is really an exciting area if you are able to make a claim, because effectively it's a way to put free money into your hands. Research and development tax credits are a government approved tax incentive programme to support innovation in the UK. The government knows that it needs, particularly at this time, to support the UK and its innovative industries and professions. So they're very keen to help. There's a couple of myths with research and development tax credits as well that it's worth displacing before we begin. A lot of people think that research and development has to come up with a new product or a new process at the end of it. And that's incorrect. It doesn't always have to. It also is assumed that the project has to be successful, and it sometimes won't be, because you can invest in that area but not actually make a success of it. The truth is that your company has to be engaged in a project that seeks to achieve an advance in science or technology. If it's doing that, it's probably carrying out research and development. For most of our clients, the advances won't be in science, they will be in the technology area. And an improvement to an existing product or process in your business could be sufficient for you to make a claim. As I said before, it's free money. So if there is any doubt in your mind about whether your process, whether your product is eligible for a claim, we'd be really happy to help. And we can organise a tax consultant to give you a call to discuss this. So the next question you're going to say is, what's it worth to you? Well, the research and development tax credit for small and medium-sized enterprises will allow you to deduct 130% of your qualifying costs from your yearly profit, as well as the normal 100% deduction that you've incurred on those expenses. And that takes the deduction from profits up to 230%. If you're in the situation where your company doesn't make any profit and it's loss-making, you can instead claim a repayable tax credit, which is calculated at 14.5% of your surrenderable loss. So if we do a very quick example, if you've got a small limited company and you've spent £100,000 on qualifying R&D, the tax relief claimable would be £100,000 at 230%. We put through the normal £100,000 that you actually spent on the project, and then the additional 130% we would adjust on your tax return to put that adjustment through to arrive at your taxable profit. So it's very valuable. As we said before, if your company is loss making, the rules are slightly different. You can surrender a loss up to the amount of the unrelieved trading loss, or 230% of the qualifying R&D spent. So again, if we have a look at an example, imagine a company which had spent £35,000 and we were able to make a claim for you. The total trading loss was £100,000. So the surrenderable loss would be the lower of the £100,000, or £35,000, which was your R&D spend at 230%, which is £80,500. So the surrenderable tax credit would work out at 80,500 multiplied by 14.5%, so £11,672. So well worth making that claim. It may be a fairly modest claim, but still well worth making the claim, making a real difference to your cash flow and your position. There are a few small print issues that need to be considered. So we'll just briefly go through those quickly. There has to be a project focused on the issue that has to be resolved, and there has to be an intention to achieve an advance in technology. The project must relate to the company's trade, or one that it intends to do as a result of the R&D. The company will have to explain how its project sought to overcome the uncertainty around the advance that they achieved. And it has to be an issue that can't easily be overcome by a professional working in that field. Of course, the small print puts a lot of people off, but as we said, we'd be happy to discuss whether you've got eligible expenditure there. Most of our clients will luckily be in the situation, or our potential clients will be in the situation, where a claim won't be prohibited because of their size. A small and medium-sized enterprise that can claim this particular branch of research and development tax credits has to meet the criteria that it's got less than 500 members of staff, turnover of under 100 million euros, and a balance sheet total under 86 million euros. The time limit to make a claim is 2 years from the end of an accounting period, which is in line with the normal deadline for correcting a corporation tax return. So if you've done it in the past and you think, I might have a claim, it's not all lost yet, please do get in contact with us and we'll check for you. Some recent examples of R&D claims that we've made include developing a new lightweight material to improve efficiency, using artificial intelligence and machine learning to develop chatbots, building a bespoke e-commerce platform. So if you've incurred any significant expenditure that you think hasn't led to an advance in technology, please get in touch.
Thank you very much, Andy. I think you can see there's an awful lot of different opportunities to save tax, some of which you may be able to benefit from. There are also other topics that we could have covered today to throw into this mix, such as VAT and other areas of the business. There's a lot of opportunities, and really, using a professional is an important move in any business to make sure you're paying as little tax as legally you need to be doing to keep your business successful through these difficult times. We would obviously, love to be able to help you with any of this. Tax-Assist accountants are established, and we're servicing clients in these areas all the time. So really, how a good accountant can help you, in these areas is it all starts with your bookkeeping. It starts with knowing your numbers, getting your records up to date, using cloud accounting products, very helpful for doing that, helping your accountants see more of your business and more regularly, so they can constantly advise you if any new tax changes come out. We constantly report on the budget, which will be coming up around November time. And again, new tax changes could be coming out there from the Chancellor. So if we're up to date with your numbers as your accountant, we can advise you quite quickly to implement some changes as soon as we possibly can. So having your bookkeeping records very important, and keeping all those receipts, scanning them in, getting them across to your accountant will make a world of difference in the tax opportunities available to you. We're on hand as your accountants to give you support and advice with those decisions, and our email newsletters, our webinars, our social media content. There's a lot going out to keep you really up to date with things, but particularly around key changes like emergency budgets or planned budgets that are coming up at the moment. So yeah, we'd love to hold a tax planning meeting with you wherever that's required. And we just want to cover off the benefits of a pre-year-end tax planning meeting. Now, some of our clients do use our accountants for these meetings, and it's useful to get the timing right, as Andy's talked about, on when those meetings are held, that we can sit down and work through all of your tax planning needs and take some various actions ahead of your year-end coming to a close. It's also a great opportunity for us to see how your business is doing and learn a bit more about your business, so we can help you with any future plans that you may have or future investments into your business. And of course, in these changing times, whilst we can meet you in our shop fronts, and we've got strict social distancing measures in place in each shop, we can also meet you over a Zoom or a Skype meeting. You can have a video meeting with us, and we can present information to you on screen, just as we're doing today. So whatever your preference, whatever works for you, we'd be more than happy to meet with you and talk to you about these opportunities. Great. Thank you, Andy. We're now going to have a look at the questions. We've got our resident IT support person, that's not his job title, but who's just going to help us look through those questions. I'm happy to answer the first one, quite a straightforward one. Is it possible to join other Tax-Assist talks that we've offered? Absolutely. If you visit our website, taxassist.co.uk, subscribe to our newsletters, and we not only give you other topics and information, but whenever we have a webinar planned in, we'll be promoting those across our newsletters. We have a series of support hubs on our websites around COVID particularly, and our webinars are also hosted in there, and the recordings will be held there once those are over. We'll definitely be getting you a copy of the slides after this session, so you'll get all the information that Andy's presented to you today.
The next one I'm happy to take from Malcolm West. Hi, Malcolm. You've asked if you believe all the speculation that there is in the press about the potential attack on entrepreneurs relief. I think on balance, there always has been since that relief. I think it was 2007-8 when entrepreneurs relief came in, replacing business asset taper relief and a little bit of indexation before that, which were the reliefs that used to apply. And entrepreneurs relief comes on from another tax relief called retirement relief, which even predates that set of relief. I think most of us in the profession would believe that it would be a terrible attack on entrepreneurs to fully remove all capital relief. But the speculation about entrepreneurs relief has always been rife, and you'll probably recall that prior to the change that you talk about, when they took the lifetime limit down from 10 million to 1 million in March, there was speculation it would be completely removed, and that didn't happen. We have had speculation that it will definitely be going, and then equally we've also had some speculation that the government don't want to have a lot of tax rises. The economy is still in uncharted waters, so I don't think we can rule anything in or out. We don't have a view on it particularly, but we would be very surprised if the government didn't want to help entrepreneurs. They're the lifeblood of the economy. We would hope that they would make provision for that. And the next question is coming from Brian. Hi, Brian. If you take dividends, you limit your ability to claim furlough. What happens if they reintroduce the furlough scheme for specific industries? Again, Brian, lots of speculation there. You're correct, because the furlough really was based on prior salary levels. And if you've taken those lower salaries and dividends, they unfortunately were not fair and penalised company directors and didn't allow their dividends to be included when we worked out the furlough. We suspect that that will stay the same. We suspect that the government won't relent on that. So if they do, as the speculation is mounted, target future furlough when it ends in October for specific industries, well, we definitely believe that they should make provision for directors, but I suspect, unfortunately, we would be surprised if they did.
Yeah, we're big supporters of that. We have a petition that's on Gov.uk site at the moment, so would love for you to support that. If you can add your signature to that petition. We are very, very close. I think we're up to 97,000 online signatures. We just needed to get to 100,000. So visit the website, go on our Twitter sites, and you'll see that petition that's been started by one of our taxist accountants to support limited company directors in that way. And
an anonymous question here, mentioning the benefits of company pension contributions, because they don't like to the idea of losing cash within the business. Maybe they don't trust a pension company, which is still an issue that people will face. Where you're looking to invest and create a pension scheme that will invest back in your limited company, you're definitely going to need some specialist financial planning there. There are a couple of schemes out there that may be appropriate, but there are restrictions on it, and there are conditions, and there are percentages in how much you can actually put in. The whole idea of the pension is that it's a safe investment. That's a financial planning area that, unfortunately, we were only really able to comment on the tax implications of it. But what we would be able to do is we would be able to put you in touch with a specialist, source a specialist for you, who could give the financial planning advice and who could look at potentially setting up that scheme. It is done. It's just something which is a little bit more specialist. And another anonymous question, just wondering about comparing dividend versus salary, looking at the corporation tax suffered, and David, yes, that is something that we do. With all of our clients, if you are with Tax Assist, we'll write to you early in the year to try and really tell you what the best extraction method is for you, and we'll bring in all of the issues. There are the issues that we mentioned before, potentially qualifying a year for state pension if that's what you wish to do. Again, that's a financial planning area, but certainly we can advise the level that you need to do to get that, the maximum income tax saving and the maximum corporate tax saving, as well as a little bit on what will actually put the most money in your pocket, because that's also quite important as well. But we will cover all of those things and bespoke arrangements if necessary. From Simon Wilson. Hi Simon, can shares only be gifted to spouses and civil partners? My girlfriend of 15 years and living together with children gifted me shares in her business last year. Have we broken the rules? It isn't necessarily breaking the rules. It's just that when you give shares to a spouse, there's a lot of exemptions that kick in. Some specialist rules that look to restrict certain situations, which could give rise to capital gains tax. The good news is that you might still be in time to make a claim or holdover relief, which is what happens ordinarily if you give shares in your business to somebody else, you're making a disposal for capital gains tax. You could potentially get hit with a capital gains tax. Obviously, Simon, I don't know the value of your business, but there could be a CGT charge there. The good news with the holdover relief claim is you've got a few years to put that in. So if you haven't spoken with anyone, we suggest getting some specialist advice. Please do get in contact with us outside of this and we'll be happy to help. Do you provide support for creating a tax-effective company structure for a property business? Is this done through subscription? We will help with property businesses, and at the moment this is a key area of tax planning. As you'll have probably noticed, one of the emergency COVID responses has been that the governments in England and also the devolved authorities, so Northern Ireland, Scotland, Wales and England, have all reduced temporarily stamp charges, whether that's LBTT in Scotland, land tax charges in Wales, or SDLT in England and Northern Ireland. Those have come down. If you are looking at using a corporate structure, either because you're frightened or concerned about the income tax charges as a result of changes which have been brought in by the government on the deductibility of mortgage interest rate, if you're concerned about the ability to invest now and take advantage of the SDLT holidays in England and other ones which may apply in the other regions, do speak with us. There is no off-the-peg solution to it though, but we'd be happy to work with you to create a solution that works well for you. A question from Russell: if I invest profits from my non-property limited company in property or development, then is all the cost of this allowable to set against capital allowances? Unfortunately, Russell, that will be an investment and it won't generally be deductible for capital allowances, so you won't get that. Generally, an investment in shares will be an investment. If in fact you took the direct step of investing in land and buildings, depending on what land and buildings it is, you won't generally get capital allowances because you don't generally get them. But you may get them on, there is a new structures and buildings allowance, but investment in shares in the way that you said, unfortunately, you won't be able to recover any of that.
A question on investigations. How far back do people go on investigations?
So which one is this one? The honest answer is it's like with everything in tax, is it depends. It depends on the behaviour. Ultimately, I think the statute of limitations for HMRC is 20 years. But depending on the behaviour, the revenue can go back 4, 6 and 20 years. So it does depend on how far you have gone. In most instances, after 4 years, there will not be scrutiny, unless, of course, there is some sort of fraud or the revenue make a discovery, in which case they may then open up the affairs of the company. I think we had
Susan's or one at the top. That specific one.
We'll probably cover that. We'll probably cover that later a bit.
Yeah.
There's a few there that we can come back to maybe.
If there are any specific questions about your own circumstances, obviously, if you're working with your local tax accountant, then please do talk to them about their specifics. If you're not yet talking to Taxist, please do get in touch with us. We will review those questions after this session and make sure we get you an emailed response or a response via the chat facility, so you can get your answers on that one. Thank you, Andy. We did do a landlords webinar previously, I believe.
We did, yeah. And that often covered personal tax. I mean, these company ones are still going to be an issue for companies.
Yeah, absolutely. Fantastic. So thank you very much. We really appreciate you attending this webinar. There'll be a recording sent to you afterwards. And I know I've seen one of my colleagues has shared the petition that would love for you to sign and support. And that's in the chat boxes as well. So yeah, please do support that. But thank you very much for attending and stay safe. Thank you.
Thank you.